Have you ever drawn a trend line on TradingView and wondered what might happen after that trend finally breaks? Most traders know how to use trend lines. Many traders know how to use Fibonacci levels. But very few people combine both tools in a way that can reveal potential support, resistance, and target zones directly from the trend itself. In this video, I'm going to show you one of the most underrated drawing tools inside TradingView. It's called the Trend-Based Fibonacci Extension. And by the end of this video, you'll know exactly what it does, how to use it, how to customize it, and some common mistakes to avoid. Let's jump right into it. First, let's quickly understand the idea behind this tool. Normally, when traders use a standard Fibonacci retracement, they select 2 points on the chart, usually a swing low and a swing high. TradingView then calculates Fibonacci levels between those points. Those levels are often used to identify areas where price may pause, react, or reverse. The trend-based Fibonacci extension takes that concept one step further. Instead of simply measuring a price move, it allows you to connect Fibonacci calculations directly to a trend line. That means you're not just analyzing a move. You're analyzing the structure of a trend. Let's see how it works. Inside TradingView, open the Drawing Tools menu. Navigate to the Fibonacci Tools section. Select Trend-Based Fibonacci Extension. Now click the starting point of a trend. Next, click the second point to define the trendline itself. At this moment, you've established the direction and length of the trend. Then move your cursor and click a third point. This determines where the Fibonacci levels will be projected. Immediately, you'll see multiple levels appear on the chart. These levels are calculated based on the trend you've drawn. If you're new to Fibonacci analysis, don't worry. You don't need to memorize every ratio right now. The important thing is understanding that these levels can act as reference points. Traders often watch them for potential support, resistance, pullbacks, or target areas. Now let's look at a practical example. Imagine a market that has been moving higher for several months. Price keeps respecting an upward trend line. Buyers repeatedly step in whenever price approaches that trend. Then eventually the trend line breaks. This is where many traders start asking the same question. How far could the pullback go? Where might buyers become interested again? Instead of guessing, you can use the trend-based Fibonacci extension. Draw the trend, mark the break area, then project the Fibonacci levels. Now you have several potential zones to monitor instead of relying purely on intuition. Let's look at another example. This time, imagine a downtrend. Price continues making lower highs and lower lows. The trend line keeps acting as resistance. Eventually, price breaks above that trend line. Now traders begin searching for upside targets. Again, the trend-based Fibonacci extension can help create a structured framework. You instantly have reference levels that may help you organize your analysis. Notice that I said organize your analysis, not predict the future. That's a very important distinction. One of the biggest mistakes beginners make is believing that any indicator or drawing tool can predict market direction. No tool can do that consistently. These levels are not guarantees. They're simply areas that deserve attention. The market can respect them. The market can ignore them. And sometimes it can move straight through them. That's why risk management always comes first. Now let's talk about customization. This is where the tool becomes much more powerful than most people realize. If you double-click the drawing, you'll open the settings panel. From here, you can control almost every aspect of the tool. You can show or hide individual levels. You can change colors. You can adjust line styles. You can modify labels. You can change how information appears on the chart. For example, maybe you only want to focus on a few key levels. You can remove the rest and create a cleaner workspace. A cleaner chart often leads to better decision-making. Too many lines can create confusion. Another useful feature is extending the levels across the chart. This allows you to project important zones into the future. As new price action develops, you can observe whether the market reacts around the areas. This is especially useful when you're analyzing strong trends or markets making new highs. You can also reposition labels. Move them left, move them right, or place them in the center. It may seem like a small detail, but improving chart readability can make analysis much easier. Now here's a customization idea that many traders overlook. You don't have to use traditional Fibonacci values. You can create your own structure. For example, you could divide the trend into equal percentages. You might create levels at 25%, 50%, 75%, and 100%. This transforms the tool into a trend measurement framework rather than a traditional Fibonacci tool. The flexibility is surprisingly powerful. Another feature worth knowing is the reverse function. Let's say you draw the tool expecting a bearish move. Then the market suddenly reverses and starts moving higher. Instead of deleting everything and starting over, you can simply reverse the drawing. The levels will flip accordingly. This can save a lot of time when markets change direction unexpectedly. You can also display prices, percentages, or both. Some traders prefer seeing only the ratios. Others want the exact price levels. The choice depends on your workflow. Experiment and see what feels most natural. There is also a logarithmic option. This is particularly relevant when analyzing assets that experience large percentage moves over time. Many long-term traders use logarithmic scaling because it can provide a more proportional view of price movement. If you're not familiar with log scale yet, that's completely fine. Just understand that it changes how levels are calculated relative to percentage growth. One feature I personally recommend exploring is adding notes directly to the levels. You can label areas as potential support, potential resistance, profit target, or even reminder notes for future analysis. Small details like this can make your charts much easier to understand when you revisit them later. Before we wrap up, let's cover 3 common mistakes. Mistake number 1. Using the tool on random price movements. Always start with a clearly defined trend. The better the trend structure, the more useful the analysis tends to be. Mistake number 2. Treating every Fibonacci level as equally important. Price rarely reacts perfectly to every level. Focus on areas where multiple forms of analysis align. Mistake number 3. Ignoring market context. A Fibonacci level should never be viewed in isolation. Always consider trend direction, volume, support and resistance, and overall market conditions. The best traders combine tools. They don't rely on a single tool. At the end of the day, the Trend-Based Fibonacci Extension is not a magic formula. It's a visual framework. It helps you organize information. It helps you plan scenarios. And it helps you analyze trends more systematically. The more charts you practice on, the more comfortable you'll become with identifying useful setups. So open TradingView, test this tool on different markets, experiment with the settings, and see how it fits into your own analysis process. If you found this tutorial helpful, make sure to leave a like, subscribe for more TradingView tutorials, and let me know in the comments which TradingView tool you'd like me to cover next. Thanks for watching, and I'll see you in the next video.